Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny. And today, holy crap, we're going to talk about this week. It was mega cap tech stock earnings. Meta, Google, both stocks I own reported this week. We give you a little take on what they had to say. And then Dylan's going to give us an idea of which one he'd be buying at this moment in time based upon some price numbers I'm going to give you.
Ooh, where's the button? There
Two stupid guys trade stocks.
Where's button is actually the most common phrase Dylan says in the bedroom. Just
Yeah. Oh, wait. Hold on. I have something for that. Nope. Wrong button. All right. Wait. No. There we go.
Yeah, there you go. But what Wall Street heard from their earnings reports, they like both. This was Alphabet after they reported earnings. It was a 9% for the week. Nice little solid jump there when they actually reported. And top line numbers here we're going to talk about. Basically, this is what the report from CNBC had to say. They basically had 7% revenue growth, and they hit on top and bottom line, beating expectations. They broke out a few other segments here. The big thing I take from this is that ad spend is back, that no one has, curtailed their ad spending any further. Companies are still, spending for advertising, and, YouTube is going to be a major kind of, recipient of that as Google as a whole. And, Google Cloud outpaced their growth estimates. Google Cloud is actually the only other profitable unit amongst Google, in case you didn't know that. Did turn profitable Q1 and continued to expand this quarter. Having a solid, I think it was like 29% revenue growth year over year. Pretty sexy, right?
That's kind of awesome. That's a lot.
Yeah. The nice thing, you're kind of starting to see a pattern amongst several of these major tech stocks kind of reporting here, is that we've now returned to like a revenue growth phase a little bit. They had this massive spike during during the pandemic when everyone had cash and people were throwing everything at everything, and then they had this tough kind of comps to compete with. But now we're returning to a new growth phase. It looks like slowly. You're kind of seeing this mirrored across several different companies that are reporting. I just saw that graph was pretty
nice.
So, in terms of the actual, revenue growth here, they're saying if it was constant currency, 9% year over year growth, right? We're getting close to that double digit growth territory, which is a pretty sexy number.
Yes.
Now, this is not something you can do for basic old stalwart companies, but these mega cap tech stocks continue to deliver sizable growth, even despite the fact that they're freaking enormous, which is why they drive such a large portion of the market.
Yeah, it's really hard because one, we're way past a bull trap. We're going to talk about that tomorrow. But you would think that eventually this is going to stumble and there's going to be a recession. And if these companies all report a bad quarter in like the next 4 quarters, it's probably going to happen. But dude, just Apple, Meta, it's wild. They just can't mess up.
I wouldn't say that they can't mess up, but I would say that don't forget they got to where they are by being shrewd businessmen, right?
Yeah.
By being really good at what they do. And you're seeing a little reflection of that in the operating margin, right? So they had some contraction because they grew massively, they overextended themselves, they hired a bunch, but they've been all curtailing their kind of employee totals and trying to bring costs back in line. And now you're seeing the operating margins start to expand again a little bit. 28 to 29% is not exactly a huge bump, but it's moving in the right direction. For a while, operating margins for these major, kind of tech companies was contracting, and now they're moving back towards an expansion phase.
Got it. Sweet sauce.
So, as far as where the rubber hits the road a little bit here, so stock-based comp for Google, Alphabet, $5.7 billion in the most recent quarter, but they were able to offset that with repurchase of shares of $14.9 billion of share repurchase in the most recent quarter.
All right.
Yeah.
You never want to have those numbers flipped. That's a problem. That's your crappy little companies that are about to go bankrupt. Peloton, I think, is up there.
Yeah, probably. Yeah, definitely. I want to give you a little valuation metric here in a second. I'm curious what you think as far as the value relatively compared to, where it stems, I guess, as far as prices,
Okay.
No, he has no idea what I'm talking about.
I don't.
I didn't do a good job explaining it. So this is from their most recent quarter for Alphabet. They had $21.7 billion of free cash flow.
Okay.
Right? So a little fun with numbers thing here. I wanted to see what sort of yield that's really giving you, right? Yield kind of, I think, helps you put, kind of corporate valuations back in perspective from how much money am I earning back on what I pay for the company today.
Right.
So their trailing 12 months free cash flow was $71 billion. They have $118 billion in cash and cash equivalents, $13.7 billion in debt, and then they have a market cap of $1.672 trillion as it closed today. That gives them an unlevered free cash flow yield based upon the trailing 12 months cash flow here of 4.5%.
It's not great.
5%? You don't think 5% is a good return on your money?
Not when inflation is 7.
Okay, that is fair. Inflation has come down from the 7%, so I wouldn't use that as a per se like a good comparison. I look at it more like a core PCE, which we're now getting into like the 3-something territory. And don't forget, this is on a company that this most recent quarter had almost 10% revenue growth. Yeah, so this yield is relatively cheap compared to the growth, I would say.
So it's a trick question. If you're looking at just these numbers and you take out Google, right? If you don't know the company or the fact that it's in the tech sector, the cloud is growing like crazy, I don't think this is attractive. But then if you put in the other part of the picture, I think it's super attractive. But if let's say inflation's at 4%, you're getting 0.5% return on your money per year. That'd be incredibly low. But once again, that's only looking at these numbers. That's like if you had, I don't know, like Kellogg's as a company and I didn't know anything about it and just put the numbers.
I mean, you're slightly above the 10-year yield, right? Because the 10-year yield right now is like 3.8%. So we're getting a little premium over that. And Google compared to U.S. Treasury, both are, I would say, on the spectrum of investments, relatively safe investments.
Super safe.
But Google would arguably still be riskier than the U.S. government.
Yes. I don't even know. Yeah, I mean, yes.
Yeah.
Yes.
U.S. government prints the money, Dylan. Don't forget.
Yeah, I know. I was never mind. I'm not going to say.
And then because they did have this kind of tail effect of where they had overextended and they had expenses that were kind of high, I went ahead and just annualized up the most recent kind of quarter of free cash flow. So that'd be about $87 billion a year if they were to just annualize out this quarter, repeat this times 4, giving them a free cash flow yield at that point about 5.6%. So now you're talking about
significantly more attractive,
almost 2% above the 10-year yield.
And once you put into the fact that cloud is becoming, I mean, it was like you just had to say cloud like 5 years ago. It's kind of like AI on your call. So the fact that cloud is growing a significant amount and is profitable, that's pretty huge. That number is probably going to go up.
Yeah. Well, definitely their actual operating margin will go up over time as cloud becomes a larger and larger portion of their business, because that is a fat margin business, right? Meta had an even better week, 10% this week.
I hate my
Sexy
life.
as hell. Same thing. Market really loved their kind of report, and they had a little dip with the market on towards the end of the afternoon on Thursday, and then Friday went up again too. But we're going to talk about their quarter. I listened to both conference calls too, by the way. Nothing earth shattering. There's one thing here from Meta's call that I want to mention though. That's kind of funny. So same kind of headline, right? They just copied and pasted this week. They both beat top and bottom line, right?
Yeah.
The Meta's growth was a little bit better. They actually did break into the double-digit territory, even on a non-constant currency basis. And when you adjust for a constant currency basis, that's even better. The both did talk about in their conference calls too that that's going to continue to be the trend, that these kind of companies are betting that the U.S. dollar is going to continue going down towards the end of the year, which is interesting because that's often a tailwind for stocks as the dollar devalues. Now, since they earn a lot of their money or revenue outside of the United States, that's going to continue to kind of allow them to have better growth than they would organically, just because now the dollar is devaluing as opposed to being like a headwind where it was before, where they had to fight it the entire way.
Right.
Yeah. So here's the numbers: $2.98 per share in terms of EPS versus 2.91, $32 billion revenue versus 31. They did continue to grow their user base, which seems utterly ridiculous that a company that almost everyone on the planet that has internet access and permission to access these sort of family of apps programs are continuing to use them. And they were able to also grow their ARPU, their average revenue per user, from 1063 versus 1022 expected. Right?
I'm so upset that this stock taught me one of the greatest lessons. This in the video: you never trade a stock, never try to time the market with a stock that you want to own for 10 years. I sold this at 150 like a fucking idiot.
Yeah, I think my greatest regret is not buying more.
Yeah.
Unfortunately, I had achieved 100 shares of Meta when it was at like $85 a share. I literally had bought my last block, I think below 90, and I was selling covered calls on the way up, and it just moved so fast that I ended up selling a chunk at probably similar territory, 145, and then I bought back in at like 175. So I did buy back in, but I didn't buy back in as much as I had sold. So I ended up buying back like 30 shares as opposed to the 100 that I had owned at one point in time.
Sucks.
Yeah, definitely. The speed of this was pretty astronomical.
Wild. It's up 400% since its low.
Yeah.
Like, jeez.
And you're seeing why. Look at this, right? So the Meta basically came out and said that they are expecting revenue for this quarter to be 32 to 30.4.5 billion. They were only expecting $31 billion in the street. So they're already up. They upped their guidance for this current quarter.
Yep.
And it suggests a 15% year-over-year growth. You're now moving into solid, like, mid double-digit teen growth for year-over-year revenue numbers. And that's in their year of efficiency where they've been trying to cut back on their expenses. So this chart right here came from the earnings presentation. And I mean, God, look how fat the operating margins were back here. Insane. They took a significant dip, right? This is where they kind of had overgrown themselves a little bit. Right?
Yeah. They also had
like 20%.
Significant amount of spending too during that time.
Yeah, but now you've seen them able to kind of jump that back up here. So they had now a couple quarters of consistent growth in their operating margin, re-expansion. And despite that fact, I want to say they said that only about half of the announced layoffs have been carried out for this year so far.
Okay,
so they still have
only
more
half?
to go.
Ooh.
Only reflected in their employee count, only half had happened so far. I think most of the expenses related to that had happened in the first couple quarters, but the actual employee number still about half or so left. In terms of the actual revenue growth here, looking at this 11%, like I said, it's sexy as hell, and on a constant currency basis, I can't remember if that wasn't on here. It was even like a little bit better, which is the crazy part. Now, as far as like I said, the growth in users, that's insane to me that they're continuing to grow. Look at this.
Yeah.
7%, 6%, 5%, 3%. That is a lot of growth on a company
I don't get it. It's like it has to slow down at one point, but it's like 33% of all people on Earth or whatever. Actually, it's more than that. Like I don't even now granted there's like multiple accounts, but whatever.
Yeah. And they launched another one, which Threads, which they said potentially could be like their sixth piece of their family of apps program. I don't have high hopes that it's going to move the needle for them, but it's still nice to see the fact that as they did talk about this in the conference call a little bit, they have a playbook. They know how to to grow an app like this and to generate better user engagement, and then over time they eventually will monetize it. And Zuckerberg kind of gave us an idea of I think a text-based kind of communication platform like this could have 1 billion users. It was his aspiration for it.
I mean,
crazy.
They're on the way, so it's going to take a little bit, but
yeah, there's plenty of reports this week about how like engagement down already like 80% from when it first launched and things like that. So I know I'm not hanging my hat on anything related to Threads. Ad impressions, price per ad. Now they did say that they are actually delivering 34% more. They did still have a contraction in the price per ad of 16% year over year. That's a trend that we've seen continue to happen for a while. It seems to be decelerating slightly in terms of the decrease in price per ad, but we're still seeing them able to maintain the revenue growth because they're showing you more ads. So they have more contact, more user engagement. They're able to show more ads.
Okay,
cool. Definitely something to keep an eye on. All right. So revenue, like I said, was 11% on a year-over-year basis, 12% if you actually did on a constant currency basis. In terms of share repurchases, what do you think the fact that they only repurchased $793 million in shares last quarter?
So, I never know who's behind the decision of purchasing shares, if it's like a stock market trader, if they have some of their staff who's like, all right, this is a good choice, or if it's just like, hey, let's just buy a certain amount every year. Because I would think going up 400% in 4 months would not be the best time to buy shares. You would think there's going to be a correction. Could be wrong. I mean, I would have thought there was a correction like a month ago. There still hasn't been.
Yeah.
So maybe there's a little bit of that, but I'm not really sure who decides that.
Yeah, they didn't comment on it. They do still have almost $41 billion in authorized repurchases left. Now, I think it is prudent. They're signaling to us here, to me, by this. They're saying that, the stock has gotten a little frothy, and
I
that
agree.
we're unwilling to do that. But that's something as a long-term holder of something I want to see. I don't want to see them taking $41 billion and throwing it at the stock when it's trading at all-time high, and I know it's not there yet, but that's less than ideal from my standpoint. I want to see them wait and see if they can get a better kind of purchase because they're the ones who know the internals of the company and what the valuation really should be, right? They have the best data.
That either shows fiscal responsibility of what you just said, or they know on the inside, like, we're too high. We shouldn't be this high. So
yeah, I'm going to do the same calculation I did for Google here in a second. But cash and cash equivalents, $53 billion. They had $10.96 billion, almost $11 billion of free cash flow this quarter. They do still have $18 billion in actual long-term debt, which is very reasonable given their cash flow. So this is where I was talking about the decrease of headcount, 14% over a year. Approximately half of the employees impacted by 23 layoffs are included in our reported headcount of June 2023. So they still had about half of the employees are actually included here that are going to be laid off this year.
Okay. All right.
They did take most of the expenses, though. Yeah. All right. So I ran through the same calculation here for Meta as of currently. And this one I just did the annualized. They had one quarter where they reported like $197 million of free cash flow. So that like skewed everything. And their trailing 12 month is actually only like $23 billion, despite the fact that $11 billion came from this quarter alone.
Okay.
So it's not... I don't know. You could certainly run the number on that, but I just thought it would be a less reflective number than just trying to annualize out what they did in the most recent quarter. So if you annualize it out, you're looking at about $43.84 billion in free cash flow over a 12-month period. They have the $53 billion in cash, $18 billion in debt, market cap $834 billion, sorry, and the unlevered free cash flow would be about 5.4% based upon these numbers here. So what do you think as far as like the fact that both Meta and Google are kind of priced in the same range right now?
So if you're asking which one I'd rather buy, I think the timeline is super important because my answers are different. If it's hold for 10 years or hold for 2 years, it changes. Ooh. So 10 years, it's Meta, no question. It's not even close. And the reason is Google is too safe. Whenever they try to go out on a venture, like they come up with like cloud gaming, like Google Glasses, any bad news, they just murder the project. They don't put adequate funding to anything. They're kind of they're just, I don't know the right way to say it. I don't want to be
wishy-washy. They're not committed.
Sure, that's a better word that I'm thinking of. That's more appropriate. Mark Zuckerberg, say what we want. That guy's got balls. Like he's also he's the founder, so he's still the imagine. What am I trying to say? Oh boy,
he's the dreamer. He's a visionary.
He's the dreamer. He's the visionary, right? So like Tim Cook, they don't put out new stuff. I mean, they finally are putting out the new goggles. We'll see how that goes. But Mark Zuckerberg and the entire virtual reality thing, that could be another whole Meta game changer. It could be absolutely massive. But in 2 years, Meta's gone up so much, it's stupid. And Google has not, but they're still making a bunch of money. So I would do Google for 2 years.
Interesting. Yeah. So I mean, the nice thing about the stock market is we really don't have to pick. I own both, which is awesome.
Yeah.
I think right now they're probably close to equal weighting. You remember I sent you a text about okay. For me personally, I think they're close to equal weighting. That's after this massive run, though. This was the interaction. I texted Dylan about this week when I listened to the conference call. It was pretty funny to me. Where this analyst asked, he's like, Mark, things are moving quickly. Like a month ago, we weren't talking about Reels. A quarter ago, we weren't talking about Llama. In the start of the year, we were barely talking about AI. If you think back to the kind of just how you were prioritizing your time at the start of the year, where you are today, how this kind of has changed, would love to just get some color. They love saying that on kind of the changing priorities and really where you're spending your time. Mark is just like, yeah, I could start with that first, and then Susan can take it second. I actually think our priorities have been pretty consistent for years now. I love that. He basically just like whipped his dick out. Was just like, hey, by the way, like I saw this coming. I've been on the AI train here for a few years now. Ever since we knew that Apple was going to be taking away the app tracking transparency thing. He's like, like in point of fact, he goes, getting quite a bit of critique on the volume of our AI capex spending that we were doing, and now obviously people want to understand, where that's going and where we think we have a trajectory is going, and want to make sure it's as efficient as possible. But I think at this point, it's more than well understood that I think that was a good investment and is driving results in the near term. Basically saying, I was right. You guys were doubting me, and you're all a bunch of idiots. There's the reason why I am the multi-billionaire founder of this company, and you're just like this guy who doesn't even know what program you're talking about, because they were definitely talking about Reels. He meant actually Threads. So, misspoke there.
I wish he was a little bit more mean, because he was getting a lot of shit. If you remember those conference calls for spending money on AI, just like he's getting shit right now for spending money on virtual reality. He's like, well, I was right. So thanks a lot. That's why I own the company and you don't. So
Yeah, exactly. And there was this great quote from Zuckerberg, I think a few quarters ago, where when he closed out one of these, and he said, he's like, I think the shareholders that believe in us long term will be well rewarded for having faith in us. And I think we've already hit that phase. So we can only see what happens in the future.
I'll never doubt him again. So all right, guys.
That's the next one.